Good afternoon, and thank you for attending Global Views and BTU Analytics joint webinar titled Northeast Natural Gas Outlook, where you'll hear about the key factors influencing the Northeast natural gas markets from Tony Scott at BTU Analytics. Tony is a partner at BTU and is Managing Director of Analytics. My name is Tom Mallon, and I'm Vice President of Strategy and Alliances at Global View. Global View is a leading provider of market data management solutions. Our Market View solution aggregates real-time, historical, and proprietary market data from exchange-traded instruments, OTC derivatives, market assessments, price corrections, statistics, currencies, news, reports, and more. We offer one of the only SaaS-based solutions in the market, delivering unprecedented levels of portability and accessibility to our customers, whether they are working in the office, at home, or on the road. You can learn more about Global View and our solutions at www.marketview.com. BTU Analytics was founded by an experienced team a year and a half ago to provide an independent, nimble, and fundamentals-based platform upon which energy market participants can make investment, trading, and strategic decisions. During this tenure, BTU has delivered over 50 one-off consulting projects and acquired an impressive list of companies as subscribers to their ongoing analysis offerings. By combining the best data, an integrated platform, and experienced analysts, BTU Analytics is able to explain trends, forecast results, and keep their subscribers ahead of the market. Data and news from BTU Analytics has recently been added to MarketView. This data includes regional production forecasts for the North American oil and gas markets, as well as horizontal and vertical well counts. News includes BTU Analytics Upstream Outlook Report, as well as their Energy Market Commentary Report. Before I hand the presentation over to Tony, I want to run through a couple of housekeeping items. During the course of the presentation, you may submit questions online via the questions dialog box on your screen. These questions will be answered during the question and answer session following Tony's presentation. Also, for those attending today's webinar, you will receive an email containing links to the summary of BTU Analytics' recent study entitled A Firm Dilemma and a sample of their Northeast Gas quarterly publication. You'll also receive a link to request a 30-day free trial of MarketView Desktop from Global View, as well as a link to listen to the webinar recording. And with that, I'm now going to turn the presentation over to Tony.
Thank you, and this is Tony Scott, and as I mentioned, I'm one of the owners and partners here at BTU Analytics, and our agenda today is to talk about Northeast gas markets. We've got about 40 minutes allocated for the discussion today, and it's really an excerpt from a recent market study that we published at the beginning of August, digging into the dynamics in the Northeast market, including production and transportation, hedging, and well-level economics, and how all of that combines together into our views. And looking at some of the key takeaways in the market and out of this study, one of the things that we've been looking a lot at is certainly the fall in crude pricing and the impact on NGL pricing. If you look back from 2009 to 2014, natural gas prices have been between as low as $2 an MMBTU and as high as $6 an MMBTU, but averaging right around $3.50 to $4 an MMBTU. But gas productions continue to grow over that time frame, in part because of the Marcellus and Utica, but also in part due to the high liquids prices that we've experienced over that time frame. And now with where liquid prices are, both for NGLs and for crude oil, producers are being forced to really rely on their best dry gas assets, and especially for Marcellus and Utica producers, to try to survive the low NGL and oil price environment. And a lot of these producers have taken on significant midstream and transmission pipeline commitments to the tune of over 20 BCF a day of long-haul firm commitments. And they've done this on the back, as we'll see in some of the slides here, and covered in our monthly upstream outlook. When we look at well by well break-even economics, look at sections that have been drilled, amount of drilling locations left inside of those sections, We see, even before the service cost environment we're in today, a tremendous inventory of sub $2.50 break-even type locations across the Marcellus and the Utica. Now, the number of locations is certainly also varied by higher liquids prices, but even in just the dry gas locations, it's years of drilling inventory left to try to satisfy those pipeline commitments that producers have taken. On the longer term, on the demand front, I think a lot of folks are now starting to figure out. We've been spending a lot of time looking at global LNG markets, where we think that those supplies can go, and the relative competitiveness of U.S. LNG, both on a full cycle delivered cost basis as well as a variable transportation cost basis. And we're already starting to see the impact of Australian LNG coming into the market, and we haven't even begun to see U.S. LNG tip its hand into the market, but we're already seeing the spreads between the U.S. and Europe tighten, one with lower oil prices, but two with increased supply in the market. And so if demand, there's a lot of production forecasts out there that are predicated on significant movements of LNG out into the market in order to incentivize price recovery in the U.S. But if the global market isn't there to absorb it, that means these producers in the Northeast that have committed to more than 20 BCF a day long-haul transportation commitments could begin to see these transportation commitments move from being an asset in the current spread environment of Dominion South and Henry Hub and Chicago to really being a liability. Some of these producers, have taken double and triple their current production in terms of capacity commitments, and so either they must grow or somebody else will. And in the capital environment that we're in the ability to fund from internal cash flow being extremely limited at low oil and NGL prices, some of these producers may not be able to keep up. As we sort of now dive back into looking at the Northeast market, you can think about the Northeast as really being a regional constraint box at a high level. Those constraints envelop Tennessee Zone 4 in Northeast PA, Transco Leidy Line, TETCO M2, Dominion South, and when you look at cash prices in those markets in the wintertime, you see even internal constraints inside of the Northeast region. In the winter of 2014 and 15, which was an extremely cold winter, producers still saw extremely low pricing, sub $2 in Northeast PA, where you've got dry Marcellus production. And then as you move over into the wet areas of the Marcellus and in the Utica, similar weaknesses in pricing in Dominion South at $2.27, and the one bright spot in TETCO M2 at $2.65. But as you start to look at demand markets in the wintertime, even in very close proximity, trading much stronger. You look at Transco Zone 6 at almost $6 an MMBTU. As you move up into New England, over $9 an MMBTU. And even just across Ohio, moving from Clarington in eastern Ohio to Lebanon in western Ohio, we saw over $3 an MMBTU. So significant spreads in all directions for those producers. But as demand lulls in that market in the summertime, we look from April of this year to September of this year, we've seen that pricing box shift further east in the Northeast, enveloping the TETCO M3 market as the mid-lull drops into Philadelphia and other eastern markets there. You see Transco Zone 6 still a premium, but not certainly the premium that it is in the wintertime relative to these other markets, because they can source the majority of their supply from the Appalachian region, from the Marcellus and Utica. And producers have committed to significant pipeline infrastructure to move in all directions to try to capture those higher prices. When you look at Dominion South to Lebanon in the west, you have over a $1.30 spread. in those markets, and so you've seen producers take capacity on REX, on TETCO to Uniontown, both of which have expanded and went into service this summer, and then developing new pipelines like Rover and Nexus to try to capture those higher prices in the Mid-Continent. When we look at the region, we divide the country up into various boxes. We have Appalachia, which includes the Marcellus and the Utica, and then the states of New York and New Jersey, Pennsylvania, West Virginia, Ohio, and Kentucky, really being that box that we talked about a minute ago with some micro constraints moving even in and around that. But when we look at that region relative to Marcellus and Utica production, we go back to 2010, you see demand in the region there in the light blue line, Appalachian dry production in the dark blue line. Back in 2010, Marcellus and Utica production only combined for about 2.5 BCF a day. But by this winter, production has grown to almost 18 BCF a day in the region. And inside of those states, demand on average is only about 12 to 14 BCF a day, depending on the year. And last winter, even with as cold as it was in the Appalachian market there, we almost were able to meet peak winter demand with local supply. And we would expect going into 2016 and beyond, the Appalachian region has to be moving gas in all directions in order to continue to grow and in order to produce. This next slide here is a sample out of our upstream outlook and out of the Firm Dilemma paper, looking at those well-level break-even economics across the areas. This is run well by well, looking at actual production data, modeling out type curves on a well-by-well basis, modeling individual capital expenditures per well, royalties, severance taxes, and what you see historically is very strong break-even economics in Northeast PA, where producers like Cabot and Southwestern and Chief and Talisman over the years have developed acreage and really was the start of the growth in the Marcellus back in 2009 and 2010. But then when you look at and this is at a higher oil price, this is at a $60 realized crude price and a $24 NGL price, certainly much higher than where we are right now in the market. But it gives you an indication of just how much acreage and over what aerial extent producers over the last 2 years have been seeing extremely good economics, and why they were so motivated to take all of these capacity commitments, because the dark green there represents break-evens between $1.50 an MMBTU to as high as $2 an MMBTU there in green. And when we zoom in to the Northeast PA part and look at those historical break-evens in 2013 and 2014, you see producers, some producers able to drive costs as low as $1.75 an MMBTU. But when we look at year-to-date pricing in Northeast PA, producers that are exposed to the spot market there are only realizing $1.25 an MMBTU. So even the best producers' wells are not generating attractive returns at the kind of pricing that local market is experienced right now. Now, a lot of those producers also have firm transportation commitments and hedges, that don't subject them to the full weight of the pricing. But this is where we've seen operators like Cabot and Chesapeake and others announce deferred completions, announce shutting in physical volumes of gas, because if they were to continue to produce at the pricing levels that we're seeing today, they stand no chance of generating an economic return on some of the assets they've developed. Now, as I mentioned, we build this model well by well. We go out and grid where we've seen wells drilled, allocate break-evens to each of those grids, and that allows us to build up an estimate of the number of remaining locations given a spacing assumption at each of those break-even points. And when we look at Northeast PA, we've drilled slightly over 700 wells to date that have broken even below $2 an MMBTU. And when we move forward in time, in order to satisfy our production forecast, even through 2020, we don't consume all of the sub-$2 locations, assuming producers are able to, target those locations directly. That there aren't secondary issues in holding leases or and smaller midstream constraints. It allows that area to continue to grow at very low marginal costs for a lot of those producers, contingent on them receiving and getting new transportation into that market. When we move forward here and look at this at a slide out of our paper, A Firm Dilemma, as we go through, there's roughly 45 BCF a day of projects scheduled to come online between the end of this year and 2020. When we look through those projects, look at the projects that we believe actually move the goalpost or move the line downfield here in order to reach a new market, there are over 20 BCF a day of that 45 BCF a day of projects that move the line for these producers and allow them to access higher price markets. And the other thing that we took away going through that analysis, looking at which producers committed to which pipeline projects and how committed each of those major projects were, is that there were very few pipeline projects that had not received nearly full commitments. And that allows a lot of potential growth from these projects. It also gives us a lot of assurity that these projects will likely be developed. Now, there are certainly some risks to these projects in construction timing. Some of these projects, such as Constitution, it's no secret that Constitution has faced trials and tribulations of trying to build into the New York market and up into Iroquois, with a couple years of delays going on with trying to receive tree cutting permits and stream crossing permits. A lot of other pipeline projects are going to face similar hurdles. But we think these pipeline projects are going to continue to try to press forward, even with environmental pressure, because they've already received a significant amount of firm commitments from producers. When we look at then on the producer side, this graphic here, the dark blue line represents current capacity commitments. These are commitments to existing projects today that are flowing. And then the light blue line, or light blue bar there, represents the incremental capacity commitments that are expected to come online by 2017 for each of these operators. And then the dark blue circles there are tied to the right-hand axis and represent the percentage of production of current 2015 production relative to those transportation commitments. And you can see the first operator there today has over 3.2 BCF a day of transportation commitments that are expected to be in service in 2017, and that represents almost 250% of their current production. So they need to more than double their production from where they are today in order to satisfy those transportation commitments. And you can see as you move across those operators, of the 12 of the 13 operators that are on this list, which represent all of the major producers from Antero to Chesapeake to Range to Southwestern, and are broken out and detailed out in the report, all have either commitments that match their current production today or exceed their commitments today. Only one major producer has really undercommitted to developing new pipeline capacity out of that market. So we've looked at each of these producers has extremely good economics going through in detail in Northeast PA. We've also done that analysis in the Southwest PA, in the Marcellus, and in the Utica. The other piece of the equation for these producers, they've got the upstream economics in many cases. Not all producers do, but a lot of them do. They've gone out and committed to 20 BCF a day of transportation capacity in order to move to downstream markets. The ultimate question then, have these producers protected themselves from price volatility in the medium term? And some of these producers have. When we look across these producers and look at their break-evens in aggregate across the plays, one of these producers is actually not the high. This graphic here, to explain it, the dark blue represents the producer's break-even cost adjusted for hedging relative to our price outlook through 2017, taking the value of those hedges and then deducting those values of their hedges across their current production and subtracting it from their break-even cost. And you can see one of those producers moves from being a middle-of-the-road producer in terms of break-even costs to the front of the pack. They've gone out and executed a very good hedging program that, combined with a lower pricing deck in the market, really sets them up to grow or to at least have the cash flow protection to grow should they choose to do so. Now, when we look across this chart, you'll notice that the axes aren't on there, but not all of these producers are certainly economic, even at the forward curve for Henry Hub, much less the forward curve for Dominion South. So there are producers that, without significant cost reductions, without improving well performance in their own acreage, could be pushed out of the stack over the next couple of years, depending on how quickly demand grows outside of the Northeast, as well as how long oil stays low. We're seeing monthly. We did an energy market commentary piece earlier this week on associated gas production declines, which is available out on our website for free. In that piece, we are seeing gas production declines everywhere but the Northeast. And so, that begs the question then, how much capacity is coming online that allows Northeast producers to get out of this market and try to backfill some of that declining associated gas production, as well as meet incremental demand. And we've built this analysis up area by area, looking at flows from Appalachia into New England, from Appalachia into the Atlantic Seaboard, Appalachia to the Southeast, to the Midwest and Canada. And this black line here represents that cumulative capacity into each of those markets through time. And then the light blue line here represents the net supply coming back in 2010, and negative there represents the net supply that used to come into the Appalachian region. You can see there in 2013 and 2014, as the Marcellus and Utica grew, it started to take market share away from the Southeast Gulf, from the Rockies, from Canada, and to the point where now the Marcellus and Utica are satisfying New England demand, beginning to satisfy Atlantic Seaboard demand, and with the reversals of Rex and Tennessee and Columbia Gulf, as we move out into 2015 and 2016, begins to satisfy Midwest demand and Southeast demand as well. And, our view is that by 2017, assuming a lot of these projects are able to come online on time, we start to see a divergence between the rate of supply growth in the Northeast and the rate of growth in new pipeline capacity out of those markets, to the point that by 2017, 2018, we start to see a net long capacity situation in the Northeast. Now, certainly some pipeline delays in some major projects such as Rover or Northeast Energy Direct or Atlantic Coast Pipeline or Mountain Valley Pipeline. These are all 1 to 2 BCF a day plus type projects that are all greenfield developments. Construction and environmental delays in those projects will certainly constrain producers for longer and have a more bearish effect on Dominion South and a more bullish impact to Henry Hub. But our view is that there is now enough capacity coming down the pipeline for these producers to start to put the brakes maybe a little bit on committing to incremental projects out of this market. Certainly in light of where crude and NGL prices have been over the last 12 months. Now, the other piece of this equation is certainly been LNG demand. You look at LNG forecasts from a host of our competitors and other folks out there in the banks. In 2014 and 2013, there were a lot of expectations of 7 and 8 and 9 BCF a day of LNG demand by 2018, 2020. And one thing that I think folks are now starting to catch on to is the fact that where's all this LNG going to go? When we look at the European natural gas market, it has not been a refuge for natural gas producers. If you go back, to before the financial crisis, natural gas demand actually, hit a peak in Europe of about 67 BCF a day, and has been in decline since. And it's not just a market share story like it has been in the U.S., where another commodity is taking market share from natural gas. In Europe, it's about an energy intensity decline. And if you look out at the BP Statistical Review, this is a demand trend that they expect to see not just over the next year or two, but over the next 20 years, that energy demand is declining in Europe. Now, natural gas is increasing its share of energy demand from coal, from nuclear to some extent, but the overall demand picture has been much lower in Europe. And so if demand is declining, it's not satisfying load growth. It's satisfying for U.S. LNG exports to get into Europe. It is satisfying some other source of supply. And so one of the things that we've gone out and looked at, one is the ability of Europe to take LNG. There's no shortage of regas capacity in Europe. There's over 19 BCF a day with some more facilities being developed. But LNG imports were only about 5 BCF a day in 2014. So, as you start to look at 7, 8 to 10 BCF a day of LNG export capacity developed out of the U.S. Gulf Coast, we certainly have enough to meet their current LNG imports. And then, the next piece of the equation is certainly not just displacing other LNG importers, but potentially displacing Russian supply. This would go a long way to European energy security, certainly with the tensions in Crimea and in Ukraine. There's a lot of interest in Europe in attracting a diversification in supply. And when you look at the pricing spreads between Henry Hub going back to 2010 and Russian delivered gas at the German border, there's been a huge economic incentive to do so. Even factoring in a fully loaded cost of $250 to $350 in MMBtu to cover your firm liquefaction charges for these facilities, there's been a lot of skin in the game for LNG importers. You've seen recent deals with Cheniere and EDF signing TTF-linked contracts between $7 and $8 in MMBtu, to take cargoes into Europe. But we're already seeing, pricing pressure in Europe, partly due to lower oil prices. Certainly, a lot of that is contractually linked to oil. But I think you're also starting to see the first signs of, the length in the global LNG market show up in European pricing. and that only comes under greater pressure as we start to ship more and more LNG out of the U.S. market and compete with the Russians. And when you look at facilities in the U.S., those facilities will shift to variable cost economics once they are developed, right? And we've seen this in infrastructure time and time again. Once there's pressure on the spreads and you start to see excess capacity in the market, those liquefaction charges, are sunk. I pay for them whether or not it makes, whether or not I use it or not. And so, as we start to look at that spread from a variable standpoint, there's a lot of room for Russian prices, for TTF prices, for MVP prices, to come under pressure because of U.S. LNG to get there at a much lower cost on a variable basis. And so, that begins to wrap up our presentation for today, and happy to begin to open it up to questions. As I mentioned at the beginning, certainly we spend a lot of time on oil and looking at the impact of oil and NGL pricing to certainly the oil market dynamics. But also, in our shop, we really strive for a holistic view on how, crude oil markets, NGL markets, and gas markets interact and the feedback loops that are caused there. And certainly we've seen it in associated gas production declines west of the Marcellus and Utica. We've started to see it in slowdowns of investment in the wet Marcellus and the Utica as well. But many of those producers are starting to shift some of their capital budgets into dry gas plays like the Haynesville and the Utica in order to try to grow. They have debt commitments, they have capacity commitments that they have to fill in order to stay alive in some cases. And so that leads us to be a bit bearish on natural gas prices here in the short term. But the longer that oil stays low, that is actually, in our view, a bullish signal for the natural gas markets. So, one of the questions that we've had come in is on the LNG shipping cost to Europe. We've been spending some time looking at that, and the rates vary based on a host of things. On a variable cost basis, it could actually be quite cheap if you have a capacity commitment already to a ship. You've already signed a long-term contract for a vessel. You're really just paying for the fuel. We're not experts in global shipping by any means, but we've seen quotes as low as 10 cents an MMBTU to move to Europe on a variable basis, and as high as roughly $1 an MMBTU to move to Europe. And then as you start to move into Asia, it does get a little higher, I believe in the $1.50 to $2 range to move to Asia. One of the other questions that we had is, looking at some of the other markets and how we see impacts from that new infrastructure. Specifically, the Chicago and upper Midwest markets with the Rex reversal and ET Rover and Nexus. You've got a lot of pipeline capacity heading towards the Midwest in a market today that is fully satisfied with Rockies and Canadian and Oklahoma production, and not a lot of demand growth. There's some coal to gas switching that will occur in the Midwest. You've got some industrial load growth from fertilizers, but overall, we view that as you look at those projects combined, you've got almost 7 BCF a day of capacity when they all come online. The upper Midwest market is only about a 7 BCF a day market in the summertime. It's a much larger market in the wintertime. But that would mean those pipeline projects are capable of satisfying the entire Midwest market in the summer. And so, that'll put pressure on spreads from AECO to CIG to try to incentivize flows from those regions. But we've also seen, we're seeing declining production in the Rockies. We're seeing declining production in Oklahoma. We've seen slower production growth in the Permian. And Mexico starts to provide an outlet for some of those producers to get their gas to market. And then, one thing that's certainly been on a lot of minds is, how does the Haynesville and the Utica factor into the equation? As we start to look at those markets, and certainly the dry Utica just compounds the problem and gives producers flexibility in the low oil and NGL market to try to capture what right now is a better economic incentive. But the Haynesville becomes a problem for those producers. If Chesapeake and Comstock are truly capable of being a consistent $2 to $3 an MMBtu producer in the Haynesville, you just, similarly to what the Marcellus did to the Haynesville in 2012, you now have the potential that the Haynesville does the same thing to the Marcellus and Utica in 2016. It takes away your economic incentives to ship, and they're closer to market, and thus have a competitive advantage relative to the firm costs it requires to get to market. Our expectation in terms of, one of the questions is when will Northeast production growth reach its tops? Our expectation is that we start to see production begin to level out in 2017 and 2018 at roughly 30 BCF a day. We think 30 BCF a day represents a bit of a natural equilibrium for the Marcellus and Utica. If you go back to before those plays were discovered, that market was about 15 BCF a day of demand, and that market was satisfied by 15 BCF a day of long-haul pipelines. And so, now you have the Marcellus and Utica satisfying that 15 BCF a day of local demand, as well as satisfying that 15 BCF a day of reversals to downstream markets. As you start to get beyond 30 BCF a day of production, you really are looking at developing greenfield pipelines, additional greenfield pipelines in order to satisfy demand in other markets. And we think that begins to become cost prohibitive relative to other plays and other opportunities, especially as you start to think, you get out to 2018, 2019, oil prices will not stay low forever. We're under the belief that we have 18 to 24 months of pain still to go through in the oil markets before things start to truly work themselves out through a combination of global demand increases and supply rationalizations, not just in the U.S. but globally as well, through the reduction in deep water developments and other developments, long-term, more conventional type exploration. Another question that's come down the road here is a thought on redeterminations. What we've seen so far in terms of redeterminations, a lot of banks still just letting producers go on. In the service cost environment that we are in right now, producers are able to show reserve growth, or at least a capability of putting together 5-year development programs that seem to satisfy some of their redeterminations. Now, the super over-leveraged, likely have more problems, but they have more problems than just their redetermination because of those leverage issues. So we think right now, at least in this quarter so far, it seems like redeterminations are not going to play as big a factor as we thought they might. But as we move another quarter down the road, if capital markets continue to remain tight, and don't open back up to these producers, it will continue to pose a challenge. Now, there's a question on Algonquin pricing and whether or not we think it's fair this winter. Algonquin pricing is certainly going to be driven by how cold it is and the level of LNG that goes into the market. If you start to look at the length in the global LNG market, the Northeast starts to look to be a pretty attractive place to take cargoes. We saw additional LNG come in 2015 following the basis blowouts in 2014. And now we're starting to see a lot more talk and a lot more interest, even from power generators and utilities to contract LNG instead of either pipeline capacity, because it's really 20 days out of the year that you have a severe capacity constraint in that market. As we start to get more capacity in that market with the Algonquin project, with Northeast Energy Direct, we expect to see the volatility in the basis blowouts diminish. But in the short term, LNG is really the only solution to providing that downward pressure in Algonquin basis. So in terms of one of the other questions that we've had on the call here, really gets to the pricing dynamics between Henry Hub and Dominion South, which we go to in a great extent in the paper. But at a high level, certainly 2016 looks to be a bit of a bearish year, depending on how cold it has been. Right, we're coming off back-to-back record cold winters, very high seasonal demand because of that, and a more normal type winter, knocks 2-3 BCF a day of demand out year over year. And if producers continue to fill new pipeline commitments, I think we're expecting in the neighborhood of 2 BCF a day of new pipeline capacity year over year this winter versus last year, that allows producers to move out of the market. That poses a challenge. That production on top of demand reductions from a more normal type winter, and where storage is heading right now, really sets up for a bearish 2016. But at the same time, we are seeing associated gas decline out everywhere else. If those pipeline projects out of the Northeast are late, or producers choose not to use all that capacity right away to sit because of the capital constraints that they have, we think there's a lot of gas sitting behind pipes. It doesn't require a lot of incremental capital to move. But where you connect and who actually has those shut-in wells do matter. You could see a situation that at least continues to prop us in this $2.50 to $3 range in 2016. 2017 starts to look better. We've had Cheniere come online. We start to see the second train of Cheniere, more industrial, more power starting to come into the market, benefiting producers. And then, Tom, there's a question for you on, can this data be seen through MarketView, and how do they do that?
Yes, the answer is yes. The data is available within MarketView. If you'd like to trial the data, please contact your sales person here at GlobalView, and he'll refer you to BTU Analytics to approve any trial. As far as getting access to the data, once you're satisfied with the data, just simply reach out to a GlobalView salesperson, and they'll get you the appropriate information around pricing and the paperwork that needs to be filled out.
Thanks, Tom. And then we had a couple more questions that we wanted to try to address today. If we didn't get to your question today, please feel free to reach out to us directly, and we'll be able to answer those questions. One of those first questions is, do you think producers ask for concessions from pipelines on their long-haul commitments? I think there's likely some of those discussions going on today. The announcement from Williams restructuring their contracts with Chesapeake and the Haynesville certainly alludes to that those conversations are occurring between midstream companies and producers. I think the projects that are further away in terms of development, such as Nexus, which have a lower percentage of commitments relative to its pipe capacity today, likely could see some stalling from producers, stalling from the pipeline, waiting for both higher prices in order to incentivize growth. None of these guys want to be stuck with a producer that goes bankrupt because they have transportation commitments that they can't fulfill. So I do think those conversations are going on today. Although to the extent that some of these guys have a lot of leeway in doing that, it's probably pretty small. A lot of these big pipeline projects are 20-year commitments. I mean, it's not a pushing out a 5-year contract to being a 6 or 7-year contract. A lot of these folks are already on the hook for a very long time. And the second question is really a follow-on to some of the earlier conversation around impacts to the Midwest markets. Gets back into even further upstream into the AECO market. Canada is a bit of an anomaly in the North American picture because of it has other drivers beyond just the price at Henry Hub. The entire Alberta economy is tied to oil and gas. And when you look at currency devaluation, the same things that's propping up Saudi and Nigeria and other regions relative to the crude price crash is happening in Canada as well. With currency devaluation, they get to sell gas and oil into the U.S. market at the U.S. dollar and pay their costs in Canadian dollars. And so, we're seeing higher levels of activity already through the beginning part of the season than we would have expected. You look at in Canada as a good example. They've sold their Haynesville acreage to double down on Permian acreage as well as Montney and Duvernay acreage. You're seeing this from other producers as well. So, we see a real concern that, where some of these pipelines are going should take direct market share from Canadian producers, but at the same time, those producers on the gas side are still, to some extent, on the pedal. We've seen there's only a couple places that we're still seeing new midstream infrastructure announcements, and that's the SCOOP and Canada, in order to serve liquid-rich, high gas yield plays like the Montney and the Duvernay. And so that creates a lot of challenges, I think, in how AECO gets priced over the next couple of years. So with that, I think we'll wrap it up for today. I want to thank all of you for attending, and please feel free to reach out if we didn't get to your questions today.